All right, so today we are going to do another important standard, which is IAS 21, effects of the changes in foreign exchange rates. So this is about like when the company is dealing in the foreign currency, and when the company is dealing in the foreign currency, maybe they are doing the exports, they are selling something outside their country, and they are receiving the foreign currency. And maybe it is vice versa, like for example they are importing something, they are getting something from the overseas, and they will be paying in the foreign currency. So an entity may get involved in the foreign currency due to exports, due to imports, and this not only exports import, they can take the foreign currency loan. Even in that case, it can be exposed to the foreign exchange risk. For example, if they have taken loan from the foreign country, so things like that. So IS 21 describes the effects of changes in the foreign exchange rate. Like for example, if the company is dealing in the foreign currency and those rates change at each reporting date, so what will be the effect of the changes in foreign currency in the financial statement? So IS 21 defines that thing. So first of all, IS 21 defines the functional currency. Functional currency is the currency simply in which the economic activities of a company is carried out. Functional currency is simply the currency in which the company is carrying out its economic activities. Economic activities, for example, buying and selling of goods, payments of wages and salaries, determination of price of commodities, taking loans normally, that means financing. Yeah. So functional currency is the currency in which the economic activities of the company is carried out. So like buying and selling of goods, like payments of the wages and salaries, like determination of the price of commodities by the authorities, and taking loans, financing, such as. So this is the functional currency. Okay. Like for example, if you say in Pakistan, we are buying anything from Pakistan in rupees, we are selling in the rupees. And similarly, we determine the price of goods and services in rupees. We pay our employees wages and salaries in rupees. So our functional currency is rupee. So this is the functional currency. And then you have one more currency that is known as presentation currency. Normally it is same, but it can differ. Normally the functional currency and presentation currency is the same, but it can be different. So the currency in which financial statements are prepared. So this is simply the presentation currency. Okay, then you have the initial measurement. IS 21 defines that monetary as well as non-monetary items should be initially translated using spot rates or average rate if not materially different. Now, this is actually the initial measurement. So IAS 21 defines that the monetary as well as non-monetary items should be initially translated using the spot rates. Spot rate is actually the rate at the transaction date. When you're doing the transaction, that is also known as sometimes historical rate. So if you're doing a transaction at 1st January, then the rate of the 1st January is known as the spot rate, right at the spot on the 1st January. Or average rate if not materially different. Average rate is something like, for example, if you have multiple rates, then taking the average rate. So you have the monetary as well as non-monetary items. Monetary, non-monetary. Okay, monetary items such as receivable, payable, loans. These are the monetary items. Non-monetary items are simply inventory, non-current asset. And if you remember that monetary and non-monetary, this doesn't mean like, for example, that non-monetary is something which is not having the monetary value. Non-monetary is something which are not liquid. These are not liquid. So IAS 21 defines that monetary as well as the non-monetary items should be initially translated using the spot rate or average rate if not materially different. So monetary is receivable, payable, loans. Non-monetary is inventory, non-current asset. So whether you have the monetary items or you have the non-monetary items, both should be initially translated using the spot rate. And when I say the spot rate, so that means at a particular date, at the transaction date, the rate at the transaction. So normally you have 3 types of rates. Normally you have 3 types of rates. So the spot rate, and then you have the average rate, and then you have the closing rate. So spot rate is simply rate at transaction date. Sometimes it is known as historical rate. Average rate is an average of rates. If you have different rates, for example, you know, even a day, there can be different rates within a day. Like for example, if you talk about today, so when you see different times, when you go to the Forex, so you will see that there will be different rates. So the average of those rates. And the closing rate is at reporting date. So spot rate, average rate, and then you have the closing rate. So initially, you're going to use the spot rate or the average rate if average rate is not materially different. So spot rate, the transaction rate. So initial translation, sorry, IAS 21 defines that monetary as well as non-monetary items should be initially translated using spot rate or average rate if not materially different. So this is, I was talking about the rates. Now, settlement. So when you are settling those balances, like first of all, come over here. For example, 100 units were bought at the rate of $10 per unit. Okay. And you are converting into rupees. So $1 is actually 140 rupees. Clear? So when you're going to convert it, like for example, 100 units were bought. So the entry would be debit purchases, credit payables. So now 100 units multiply by 10, it gives you $1,000, and multiply by 140, so it gives you 1,40,000 rupees. So this is how it is initially translated. Now suppose you are doing the settlement. Then the standard says IAS 21 defines that that monetary items should be retranslated at settlement date using spot rate, and now the spot rate is actually the rate which is at the settlement date, and gain or loss goes to profit or loss. Now for example, if I say, again I'm taking the example, for example, you again those 100 units were bought at the rate of $10 per unit, and now at the settlement date $1 equals rupees 130. Okay, so now you are paying for those balances. So what you will be doing, you will be debiting the payable because your payable was recorded at 1,40,000. You will be paying the cash credit bank. And how it will be calculated? It will be calculated as 100 into 10 into 130, and it will give you 1,30,000. So initially you recorded your payable at 1,40,000, but now you are paying 1,30,000. Okay, 1,30,000. So you recorded the payable at 1,40,000 and you're paying 1,30,000. So that credit, the gain, goes to the profit or loss. So this 10,000 gain will be recorded in the profit or loss. And it can be vice versa. Like for example, if it is going to 145, then the extra amount you will be paying will be the loss. So the gain or loss will be recorded. And it is possible sometimes that you are doing the part settlement. You are doing the part settlement. Okay. Now, what does that mean? Like, for example, you bought 100 units again. So your purchases were at 1,40,000. And this 1,40,000 were like 100 units at the rate of $10 and at the rate of 140. So this is 140,000. Now suppose you are paying just for the 30 units. Suppose you are paying for just 30 units, like payment. You're paying for this 30 units. So 30 multiply by $10. And what was the rate? The rate was, for example, 130. And now how much is remaining? The remaining liability will be for 70 units. the remaining liability will be for 70 units. 70 into $10 and into 130. Okay, so if you see 70 into $10 into 130, it gives you 91,000. This is the balance. This is what you are paying. 30 units, you are paying for the 30 units. This is 39,000. Okay. So the difference of these two compared to this will be actually your gain or loss. Okay. So 140,000 minus 39,000 gives you 1,01,000. And compared to this 91,000, then you will be having the gain. So when you have the part settlement, then what you simply gonna do is you have to compare that thing. You have to compare that thing with the closing liability. This was your opening liability. This was your liability, opening liability. And this is your closing liability. And this is your payment. So you're going to compare it and it will give you the gain or loss, whatever. So this is when you are doing the part settlement. So remember, when you are doing the settlement, IAS 21 defines that monetary items should be retranslated at settlement date using spot rate, and gain or loss goes to the profit or loss. Now similarly, unsettled balances. The balances which remain unsettled at the year end. So IAS 21 again defines that monetary items. So whenever I'm writing the monetary item, that means non-monetary item cannot be retranslated. So IAS 21 defined that monetary items should be retranslated now using closing rate, because they are unsettled till year end. Now you will be using the closing rate. Using the closing rate, gain or loss goes to profit or loss. And that means non-monetary items such as inventory, non-current asset, non-monetary items should not be retranslated. So you are not going to retranslate that. So this is IAS 21. You need to understand it. Again, I'm going to revise it. I'm going to summarize it. That first of all, the functional currency is the currency in which the economic activities of the company is carried out. Then you have the presentation currency in which the financial statements are prepared. Then you have the initial measurement, which says that initially monetary as well as non-monetary items should be translated using the spot rate. Then you have the monetary items and non-monetary items. Then you have three different types of rates. Then you have the settlement. When you are doing the settlement, then it should be retranslated using the spot rate, and gain and loss goes to the profit or loss. When you have the part settlement, you're going to compare the opening liability less payment with the closing liability, and gain or loss goes to the profit or loss. When you have the unsettled balances, then IAS 21 requires it to be retranslated using closing rate, and again gain or loss goes to the profit or loss. So non-monetary items should not be retranslated. This is IAS 21.